Spot Bitcoin ETFs just bled $1.8 billion in the last 7 days. MicroStrategy only has 9.8 months of cash to cover their preferred stock dividends, and the Bitcoin network hash rate is ripping back up to a zettahash. Something has to give. My name is Colby, and I've been mining Bitcoin nonstop for 5 years. And I've been involved in over $15 million worth of Bitcoin mining hardware transactions. Most of what gets said in this space is just noise and cringe. So let's cut through that and let's get down to the real numbers. So Bitcoin looks like it's about to paint another nasty red weekly candle, down 6% as we close the week here. It's been brutal. If you look at the decline of 53% from the all-time high just 265 days ago, it's a tough time to be a Bitcoiner, let alone a Bitcoin miner competing for those sats, which are now worth that much less. When we had the all-time high in network hash rate, that coincided with the all-time high that we saw in October, of course. So if we look back here at, this is Hashprice, but if we look at the overall network hash rate, we peaked, absolutely peaked here in October, coinciding with the all-time high in Bitcoin price, because of course Bitcoin miners are getting paid in Bitcoin and their revenue is typically measured in dollars, and that's called hash price. So right now, if a miner's running 1,000 terahash, that's called a petahash, then they're receiving only $28, which is close to the all-time low in mining revenue. So suffice it to say, it's a tough time to be a Bitcoin miner right now because we are testing all-time lows in mining revenue. We saw as low as $27 in early June. So it's rough, folks. And I'm not here to paint a picture and say that Bitcoin mining is easy money. We retested those all-time lows in mining revenue that we made earlier this year in February. So we're back in the gutter, and only the strong will survive. If we look at the difficulty, we had a increase in difficulty. So that means it's this much more difficult to mine the Bitcoin. 7.15% difficulty increase just a couple days ago. And that's brutal for miners because every little tiny bit of margin, if you have any margin, counts. And let's be blunt about it. Most miners right now are hashing underwater. Right now, miners are in the pain zone, and this is exacerbated by the price action. So a lot of hash power has come offline, and this year we have had more difficulty decreases than increases due to just a huge amount of hash power unplugging due to unprofitability. So we started the year at about a zettahash, and now we're finally creeping back up to a zettahash. We had a massive difficulty decrease on the 14th of June, where difficulty declined over 10%, and we are now back into difficulty increases with that latest increase of 7.15%, which interestingly enough, if you look here, it looks like that's the largest increase. Nope, we had a larger increase in February, but most difficulty adjustments have been negative, and we had that massive 10% adjustment on June 14th, followed by the big 7.15% adjustment that happened just a couple days ago. And blocks are still coming in hot right now. They're averaging 9 minutes, 44 seconds. It's still early in the epoch, so we'll see how it plays out. I expect more hash power to unplug for the simple reason that most miners are underwater. And if we look at it in terms of hash value, a miner that was bringing in about 50,000 Satoshis per petahash is now bringing in 47,000 Satoshis. And how does that play out for some of the most efficient miners? If you're running a 270 terahash S21 XP, and if you're able to get your all-in cost per kilowatt hour below 6 cents, let's say 5.6 cents, which is extremely low, and it is possible to get there. If you're running a 270 terahash S21 XP, which is one of the most efficient air-cooled machines available, and you're running it for 5.6 cents a kilowatt hour, which is extremely competitive. And if your true uptime, factoring for mining pool fees and factoring for about 5% downtime, which is about standard, you would be mining BTC for about $44,000 cost of production. You'd be producing Bitcoin for about $44,000 with the most efficient equipment at an extremely low rate. Look, that's pretty good if you've got a situation where you are efficient with a super low cost per kilowatt hour all in. But with Bitcoin retesting 60,000, that's still not easy money. I wouldn't call that easy money per se, because still the capex on those machines is still pretty difficult to make sense of right now. But I will say this, these times are typically the best time when it looks terrible. When there's blood in the streets, it's typically the best time to take your position if you want to go long BTC through owning and operating Bitcoin miners, the ASICs securing the Bitcoin network. The best time to get in is when it looks terrible. And right now, I'll be the first to admit it looks terrible. The ROI looks atrocious. Again, it's very counterintuitive. That's exactly when you want to be staking your position in principle. Again, you got to run your own numbers. You got to do your own research. And yet right now, it looks like the S21 XP at this super low cost per kilowatt hour, if you're running your own operation, the most efficient equipment, looks like this machine's only bringing in $60 a month in profits. And again, that's in dollar terms, right? If you're doing the math in dollars in hash price, as most miners do because their expenses are denominated in dollars, most miners will look at their revenue in dollars. Of course, that doesn't factor for the long-term appreciation of Bitcoin. And the most successful miners that I know, they are in the business to accumulate Bitcoin efficiently, hoping to stack Bitcoin at a price advantage, such as the XP currently printing Bitcoin at about 44,000 while it's retesting 60,000. That's the type of price advantage that you want when you're efficiently mining. Now, the key is you pick up the most efficient hardware at bloodbath prices during times like these. Let's have a quick look at ASIC prices and zoom out here. It is insane how Bitcoin mining hardware has come down in price. If you've been in the space for a little while and you look at 2021 prices, we'll probably never see it again, but prices have only come down, and the equipment that's running these days is more than twice as efficient, and it's trading for literally pennies on the dollar. Now let's talk about MicroStrategy. MicroStrategy is the current talk of the town as it's trading for basically its enterprise value. When you weigh up its assets on the balance sheet plus debt minus cash, the current enterprise value, when you're buying a share, you're basically buying the assets plus the debt or the enterprise value. And the market is currently playing chicken with strategy to see how much lower we're going to go and whether or not strategy will be a forced seller of Bitcoin. Basically, all of their preferred stocks are now trading at a very heavy discount and have lost their peg to parity. Their flagship product, STRC Stretch, which is meant to trade at parity of $100, is now trading at a deep discount of about $75. And this is interesting for a number of reasons. First of all, MicroStrategy's flywheel is their main mechanism of acquiring Bitcoin, and they only have $1.4 billion worth of cash. The common stock has been getting absolutely punished as Michael Saylor hits the ATM and continues to print common stock. But now he's got a big problem. The problem is that the mNAV is 1, and now is it accretive if he prints common stock to either fund the dividends or to buy more Bitcoin? Some would say that it's not, and that is not in the best interest of the common stock shareholder. And now the market is taking Michael Saylor's keys away if strategy continues to trade at or below mNAV 1. And also, Mr. Market is trying to see whether or not Saylor is going to buy back the preferred stocks in order to raise them back up to parity, or is he going to sell BTC? He had the token sale of 32 Bitcoin not long ago, and now the market wants to know whether or not Saylor will sell Bitcoin in order to cover these preferred dividends. Now, currently he has 9.8 months of coverage of the preferred stock dividends, but that'll go pretty quickly when he's spending that much money and it's coming out of a cash reserve, which is not enough in a sense. So we'll see how strategy will persist and how strategy will get themselves out of this predicament. Will they sell Bitcoin? Will they continue to issue common stock? And how are they going to navigate out of this predicament is very interesting, because if strategy sells and if they're forced to sell a sizable amount of BTC, we could see this thing unravel quickly. My opinion is that I think that the fact that strategy controls so much BTC and beyond their cash reserve, they do have over 30 years of coverage to service the preferred dividends. I don't think that strategy is going to unwind. In other words, I think these guys have such a strong balance sheet that they're going to be able to navigate themselves out of this. Assuming the Bitcoin's there. Of course, they have not published the public addresses of their BTC, but I do believe that strategy has one of the strongest balance sheets on all of Wall Street, and I think that they can actually outlast the market. 9.8 months of their cash reserve coverage of the preferred dividends is still a long time, and a lot can change in 9.8 months, let alone them having to dip into their Bitcoin stack. And then they have literally decades of coverage to pay out the preferred dividends for their preferred stocks. And it's a pretty interesting opportunity for those that have a appetite for the risk to come in and buy a product like STRC, which is paying currently $11.5 per share annually. And STRC just changed to a biweekly recording of the ex-dividend date and also payouts. So now it's paying out twice a month, and currently it's paying 11.5 a share. And so if you look at the effective yield on that, it's over 15% for someone that's coming in and buying it at about 75. They're getting paid $11.5 per year per share. Those dividends are now biweekly. It's a pretty attractive product if you believe that strategy is good for those payments. And the same is true for their other preferred stocks, in that, of course, they have different payout methods. So Strife is their most senior preferred stock, and the dividends are cumulative. Stretch is their bi-weekly payouts that are currently at 11.5% at parity. And as we saw, it's over 15% effective yield if you're buying it at the current discounted price below the par. Strike is basically a call option. It pays $8 per share per year, and it pays out quarterly. And then we've got Stride, which is like their junk product. And this thing's paying almost 20% because of the discount. That's their effective yield currently, because it should be trading at parity or at par of $100. And because it is trading that low, if we go here to Stride, the effective return is 18.7 at 53. Is that right? Yeah, about 18.7%. They do have the ability to suspend the Stride dividends. So I would imagine that would be the first lever that they pull if they needed to, is stop the Stride dividends. I don't know what they're going to do, but I think their balance sheet is so strong that they're going to figure out a way, because they have so much freaking Bitcoin on the balance sheet. Over 800,000 BTC. Where's that number here? 847,363 BTC. I don't expect Saylor to announce another BTC buy. He said that we need different charts, so not more orange dots on the chart. Clearly, pivots are going to happen, and I think it'll be interesting to see this play out. Not to mention, ETFs have also been hitting the ask. Over $1.8 billion, $1.8 billion sold last week. And that's another 30,000 BTC sold out of the ETFs. So, boomers are starting to experience their first bear market in the ETFs, and the drawdown of over 50% from the all-time high is real. So also the average cost basis is at about 80K. Let's look that up real quick on Check on Chain. The average cost basis of the ETF is about $84,000. And again, we're retesting $60,000. So the average ETF holder is pretty substantially underwater. If we look at this quick maths here, about 25% unrealized loss for the people that are holding on to the spot Bitcoin ETFs. Let that sink in and let me know, do you think the boomers are going to keep selling and putting selling pressure on this market? Because that could spiral and put more pressure on MicroStrategy. So we've seen how right now it's a tough time to be in BTC, but no pain, no gain, only the strong survive. We've seen how network hash rate has spiked massively, going from 862 popping about 38 exahash back up to a zettahash here, putting more pressure on miners. We had the 7.15% difficulty increase a couple days ago, and blocks are still coming in hot. So more competition for miners. Most miners are losing money at current hash price, at current mining revenue. And yet the S21 XP, if you're operating it with a really cheap all-in OPEX, is still printing BTC at about 44. So let me know, do you think it's a good time to be stacking Bitcoin at 60K? What about 44K if you're running the most efficient equipment? Let me know in the comments. There you have it. Hash rate continues to rip, and only the most efficient miners are making money right now, and margins are extremely compressed. The ETFs have been selling, and the MicroStrategy clock is ticking. So which way do you think this market is going to go? Leave it in the comments. And as always, you're welcome to join us at the Proof of Workshop. Get a free lifetime membership to a community of real Bitcoin miners. We go over the real numbers and operations of what it's like to start a Bitcoin mining business from scratch or scale it up. And you can find that link in the bio. I'll look forward to seeing you on the next Hash Highlight. Peace, love, and Bitcoin.